The widow's tax trap is the reason your surviving spouse will pay more tax on less money. And for most couples, it quietly costs six figures. Here's the math you're getting wrong. When one of you dies, your household income drops by about a third, but your tax shelter gets cut in half. So the person left behind keeps 70 to 80% of the income you have now and pays a higher tax rate than the two of you ever paid together. Less money in, a bigger slice going to the IRS. That's not a mistake in the tax code. That's the tax code working exactly as designed against the one of you who outlives the other. If you're between 55 and 70, retired or close to it, this is the single most expensive thing nobody warns you about. You've spent decades planning as a couple, filing jointly, sharing two Social Security checks. But statistically, one of you outlives the other by years, sometimes more than a decade. And the day that happens, three things change at once for the survivor. The smaller Social Security check disappears forever. The filing status flips from married to single. And a lower income suddenly gets taxed under a much harsher structure. Here's the variable the whole thing turns on. The one number that decides how badly your survivor gets hit. The gap between what the tax code gives a married couple and what it gives a single filler. Because the income only falls by about a third, but that shelter, the deductions, and the brackets falls by half. When your protection shrinks faster than your income, the survivor loses. Let's walk through exactly how much, step by step, so you can run it for your own numbers. Take the standard deduction. For a married couple filing jointly, it's around $32,200. For a single filer, it's about $16,100. The moment your spouse dies, and for most retirees, that's the very next tax year, the survivor loses roughly $16,100 of deduction overnight. That's income that used to be shielded and now gets taxed. But here's where it gets worse, because the brackets do the same thing. Watch the tables populate side by side. A married couple stays in the 12% bracket all the way up to about $100,800 of taxable income. A single filer, they jump to the 22% bracket at just $50,400. That's half the runway. So a survivor with the exact same taxable income that used to sit comfortably in the 12% bracket as a couple can be paying 22% as a single filer. Same dollars. Nearly double the marginal rate. These figures come straight from the official IRS inflation adjustments, and while the exact numbers drift a little each year, the structure never changes. Single brackets are always roughly half the joint brackets. That's the engine of the whole trap. Now stack the second multiplier on top, because Social Security taxation has its own set of thresholds, and they punish single fillers too. How much of your Social Security gets taxed depends on what's called provisional income. For a married couple, up to 85% of your benefit becomes taxable once provisional income crosses $44,000. For a single filler, that same line hits at just $34,000. Here's the cruel part. These thresholds were written into law in the 1980s and 1990s, and they are not adjusted for inflation. They've been frozen for decades, and they will stay frozen. So the survivor crosses that 85% taxable line $10,000 sooner at $34,000 instead of $44,000. Your survivor is living on a smaller Social Security check because the smaller of your two benefits is gone, and a bigger percentage of that smaller check is now taxable. Less income, more of it exposed. The math keeps pointing the same direction. Let's put the income drop on screen because people misunderstand how survivor benefits actually work. A common belief is that when a spouse dies, you somehow combine or keep both Social Security checks. You don't. The survivor keeps the higher of the two benefits, and the lower one is permanently eliminated. Gone. Here's a concrete example. One spouse collects $2,400 a month, the other $1,800. Together, $4,200 coming into the household. When one dies, the survivor keeps the larger check, the $2,400, and the $1,800 disappears. That's a household income cut of 43% from Social Security alone. Across real households, the typical drop runs $500 to $1,200 a month. That's $6,000 to $14,400 a year, permanently. And notice the asymmetry. Losing the higher earner is worse than losing the lower earner, because you lose the bigger check and you trigger single filing status. Most couples never model which death costs more. They should. Now here's where the trap really compounds, and it's the part almost nobody sees coming. When your spouse dies, their traditional IRA or 401k rolls over to you. The account doesn't shrink. So the required minimum distributions, the forced withdrawals the government makes you take, stay just as large. Except now those withdrawals land on one single filer tax return instead of a joint one. Same taxable income, forced out under those halved single brackets. That combination alone can push a survivor into a higher bracket than the couple ever touched. And then comes the Medicare surcharge, called IRMAA. The income-related monthly adjustment amount. The surcharge starts above roughly $212,000 of income for a couple, but above just $106,000 for a single filer. Again, half. And this one is a cliff, not a ramp. Being $1 over the line triggers the entire surcharge, hundreds of dollars a month added to your Medicare premiums. So, the same income that was perfectly safe for you as a couple can shove your survivor straight off the IRMAA cliff. And because IRMAA looks back 2 years, an income spike at age 63 or later quietly raises the survivor's future premiums. Bracket shift, more taxable Social Security, undiminished RMDs, and the IRMAA cliff. 4 forces all pushing the same way. Let me show you what all of this adds up to, using an illustrative example advisors model out. Call her Mary. When Mary's husband died, her income fell by $2,500. You'd expect her taxes to fall too, right? Less income, less tax. Instead, her tax bill rose by $2,078. Sit with that. Her income went down $2,500, and her taxes went up more than $2,000. That's a swing of $4,578 in spendable money. And that's before any IRMAA surcharge hits. The tax increase was about 83% as large as her entire income drop. The penalty nearly doubled the pain of losing her spouse. Now this is an illustrative figure, one modeled scenario, not a guarantee for your numbers. But the direction is universal and the mechanism is exact. Stretch it across a 10 to 15-year widowhood and the stacked cost of higher brackets, more taxable Social Security, and IRMAA surcharges routinely totals 6 figures. There's no single bill that ever arrives. It bleeds out quietly, a little more every year, which is exactly why so few people plan for it. So here's your decision framework, and it all hinges on one window of time. The golden window is the years when both spouses are alive, both retired, and neither has started required minimum distributions yet. That's when your tax rates are the lowest they'll ever be, and it slams shut the day one spouse dies. If you're in that window, the primary defense is partial Roth conversions each year. Convert just enough to fill up your 12% or 22% married bracket, up to roughly $100,800 or $211,400 of taxable income, and stop before you hit the IRMAA cliff. Here's the break-even test, the exact rule. Convert today if your current married marginal rate is less than or equal to your survivor's projected single marginal rate. If a dollar taxed at 12 or 22% now would be taxed at 22 or 24% later on a single return, convert it now. If you have a large traditional IRA or 401k, prioritize this hard. Because the bigger that pre-tax balance, the bigger the future RMD landing on a single return. And every dollar you convert also shrinks those forced withdrawals for life. If you're approaching age 63, mind the 2-year IRMAA lookback before you spike your income with a big conversion. And consider delaying the higher earner's Social Security to age 70, because those delay credits transfer to the survivor and permanently raise the check they'll actually live on. One more lever, the year of death, you can still file jointly. So that final year is a last chance for one large conversion at joint rates. That's the whole idea here. We did the math so you don't have to. Thanks for watching, and I'll see you in the next one.